Hello, everyone, and welcome to another edition of the NZX virtual investor events. Thanks for joining us today. My name is Doug Vrame. I'm with the Capital Markets Origination team at the exchange, and we have three listed companies presenting for you today. We'll get to those quickly here. I'll just run through the format basics. Each company will present for 15 minutes, and then we'll have a 5-minute Q&A session. And we'll try and get through as many questions as we can. So we really encourage you to ask questions, anything you can think of or want to know. Fire away. You can use the chat function in the webinar settings, and then we'll filter them through and get them to the various presenters to ask. And whatever we don't get to, we'll send out. So let's get to it. We've got the three companies we have today are Turner's Automotive Group, we've got PGG Wrightson, and we've got Radius Care. So we're going to start with Todd Hunter, and Todd is the CEO of Turner's, and I will turn it over to Todd now. And yeah, thanks Todd for coming, and we'll join you for the Q&A here in a bit.
Great, thanks, thanks Doug. Can you just confirm that you can?
Yep, see can see your first page there. Perfect.
Great, excellent. Well, good morning everyone. Great to have the opportunity again. Yeah, it goes without saying, Turner's Automotive Group love cars, but I thought I'd just start with a really quick reminder of the structure of our group. So obviously we have the auto retail division, which is the Turner's cars business. We buy and sell cars here in New Zealand, trucks and machinery, and damaged and end-of-life vehicles, biggest division in the group. In the finance business, we have the brand Oxford Finance, which is largely lending money to consumers to purchase vehicles, both through the Turner's Auto Retail network and a whole bunch of third-party dealers and brokers. We have our insurance business, which is again selling products back through the Auto Retail Turner's network and third-party dealers and brokers, and the vast majority of that business is mechanical breakdown insurance. And then our credit management business, which is collecting or helping corporates and SMEs on those hard to collect debts. We do a lot of work for the big trading banks and government departments here in New Zealand. We're NZX and ASX listed, employing over 700 people, with about 4,500 shareholders. And probably interestingly at the moment, we're 47th on the NZX free float market cap list. And yeah, it's interesting at the moment, there's quite a bit of chat around our potential inclusion in the NZX 50, and according to sort of the investment banks that we deal with and their analysts, they think we've got a pretty good chance of being included. Obviously, they understand the dark arts of those indexes much better than we do, and there's no guarantees, but it would be a great milestone for the business to be included. It's certainly been a sort of personal goal of mine and Grant Baker's the chairman for a number of years, so it'd be great to knock that off. We feel we've built a really good track record over the last sort of 10 years. So we've had a decade now of really steady improvements in shareholder distributions. I mean, one thing I'm personally very proud of is the 66 cents that we paid out to shareholders over the last 3 years. So I think it's a great achievement, and really I think reflects the quality of the company that we've built and the consistent way which we can deliver. We issued a little market update yesterday, which was just to let the market know that we were going to be at least 25 million for our first half, so a new record for the business in terms of half-year results, and that we're on track and reaffirming our full-year guidance to be ahead of our record result last year. So yeah, we are well on track to delivering another record on top of FY23, which is fantastic. It's been a very strong first half for our business, really good market share gains, which I'll talk about shortly, and very good growth in our damaged and end-of-life vehicle volumes as well. So, and with a sort of forecast that we've got at the moment, we are expecting a lift in the dividend for the full year. So yeah, really good to be able to announce that yesterday and give investors and shareholders a sense of where we're heading to. those who've heard from me before will have heard this formula before. So we operate this business in a very simple way, and that is we provide a quality environment for our people. They have the best chance of providing quality customer experiences for our customers, and those two things combined, hopefully gives us a really good chance of delivering quality outcomes for our shareholders. So just touching on the first bit, the employee experience, we put a lot of effort into our employee experience here at Turners. We understand the connection that they have to our ability to deliver excellent levels for our customers, and so employee engagement is super important to us. Engagement is essentially a proxy for the discretionary effort that people are prepared to put in and the attitude that they bring to work. And you can see from that graph there that we have world-class employee engagement levels, which is fantastic. I feel like we've sort of turbocharged that in some sense by bringing in our employee share scheme. So we've been running that for 2 years now. We now have over half of our team as owners of this business, and I think the combination of these very high engagement levels plus that ownership mindset is a very, very powerful combination. So really, really pleased about that. And obviously our customer experience is going very well. So we've received the most trusted brand award for the 4th year in a row. And this trust platform is very, very important to us. We operate in a market that generally stands for the opposite of trust. So to operate off a platform of trust is again a real position of strength for Turners, and something that we treasure very greatly. And then sort of thinking about the shareholder outcomes, we think we've been doing a great job of this. I think that graph really highlights that. Just a couple of little reminders for people. So we pay quarterly dividends, which is definitely different compared to most listed companies. So you get that sort of regular payout. We've now introduced a dividend reinvestment plan. So that's a new program that we've introduced just this year, and just enable shareholders to take that opportunity to effectively change out their dividends for shares in the business at a small discount. The discount was 2% for our last dividend payment. And at a share price of around $4 or so, we're tracking slightly higher than that at the moment, our dividend yield runs at just over 8%. So it's a very strong yielding stock, as well as having, we think, some very good growth opportunities. Just wanted to talk through the segments, but just a quick plug before I do is, if you are interested in more detailed information, we've got a very good deck on our corporate website from our annual shareholder meeting, which was held in August. Some really good detailed information there about the business divisions, because obviously I'm going at a reasonable pace here. In terms of auto retail, we've had really excellent market share growth, as you can see from that graph. And there does tend to be quite a bit of focus put around that market share growth being attributed to the Tina from Turners marketing campaign. And I can tell you Tina is actually right here beside me, looking over my shoulder. But it really is the combination of a number of things. It's our branch expansion. It's certainly been the building of our vehicle sourcing capability, and obviously the investment in the brand has really helped. But we've seen really good traction and growth in our market share recently. Our damage and end of life unit business continues to grow off the back of more and more older cars being written off by insurers or becoming uneconomic to repair. And just good opportunity to remind people that we do have a very old vehicle fleet in New Zealand, but we've got a particularly old cohort of cars. So about 20% of our 4.4 million registered cars are 20 years or older. So effectively they're at the end of their economic life and above the average scrapping age. One thing that I wanted to give you a little insight into was I have become somewhat of a number plate surround train spotter. So these are the Turners number plate surround. So when I'm out driving around, I always look for these because they just give me a sense for am I seeing what the market share numbers are telling me? And to be honest, the more I see of these, the happier I am. But I encourage you to give it a go just when you're out driving around. It just gives you a sense for kind of the market penetration that we've achieved, and I think we'll keep on achieving. When you look at those number plate surrounds, it's amazing the number of Turners number plate surrounds that you get to see. Our branch expansion is clearly a key part of our growth strategy going forward. We have 2 new sites coming on stream over the next couple of months. So we have Timaru in Napier, and then we've got a big program of work down in Christchurch, and then a number of other opportunities which we've got in the pipeline. So not committed sites, but certainly we're actively sort of putting offers in and negotiating on potential sites at the moment. So yeah, there's a really good program of work coming. Really excited about what's happening in Timaru, particularly based on the experience we've had more recently out of the new branches we've opened in Nelson and New Plymouth, where we've seen real momentum very quickly around market share. And I've talked a little bit previously about Nelson, which is a standout result where we've managed to hit sort of north of 30% inside 12 months. And that is the sort of traction that we can get in some of these regional markets. So this is Timaru. You can see the concept drawing at the top, and then what it's actually looking like as of Monday this week. So we are well on track to being able to open there in November. So yeah, really great to see that happen. In fact, I was down in Wellington last night and got to catch up with the new branch manager that we've employed there, and I have a very good feeling about that branch. It's going to go very, very well. Then we've got Napier. So again, you can see the sort of progress photos down the bottom there. Well on track to open that before the end of the year. So we've got that's a double size site over our current existing site. And then in Christchurch, we've acquired these 3 properties here, which are looking looking great, and those will come on stream over the next sort of 18 to 24 months, where we move from a single site location in Christchurch to this multi-site location. The multi-site location is very, very critical for our vehicle sourcing. The closer we are to our customers, the more opportunities we get, the more likely people are to bring us their car to buy off them, and that just feeds into the inventory that we then sell on an ongoing basis. Just quickly on the sort of remaining divisions. So in finance, it's been a real challenge in terms of the OCR track. So no surprise to people on this call, the speed of change has been the most significant headwind that we've had to deal with. And it's not so much about the raw numbers, it's just been the speed has been the challenge. But really pleased to see that interest rate seems to have stabilised now. And we know that once the timing of a downward movement in that OCR becomes clearer, that becomes very much a tailwind for that finance business. So in the meantime, we've really prioritised our margin and the borrower quality. And you can see from that graph that we've continued to improve our quality metrics for new borrowers. And if I think about the sort of environment that it feels like we're heading into, I think that is going to become very, very important, that we're bringing people into this finance book that have the means and the buffer to withstand, some further kind of cost of living pressures. We've also recently diversified our funding. So we completed a transaction with a large domestic funder for a big portion of our securitisation warehouse. So that's the way we fund our finance book. And as part of that process, we had Fitch come in and rate the receivables in Oxford, for which they achieved a AAA rating. So we're really, really pleased and good to have that independent sort of review and endorsement of what we knew was the improvements we've made in quality. And you can see here, that emphasis on quality is really reflecting in our arrears rates as well. So the red line is the Centrix auto loan portfolio, and we're tracking it, around half of that auto loan average. So it's a really good result for us. In insurance, business is going very well, seeing good improvements year on year, strong policy sales. We've seen our risk pricing continue to work very well for us. I think one of the things I wanted to touch on was just a reminder that we've been through some quite big shocks, in this environment. So around the pandemic and the weather events, and what this portfolio has proven out through these times is there is no catastrophe risk in this portfolio, in this insurance book at all. So largely being the mechanical breakdown insurance, it's just that we're insuring people for that surprise, unforeseen mechanical event. And with the risk pricing work we've done, with people driving a bit less because of the cost of fuel and work from home, we've seen claims frequency come down. The average claims cost is definitely tracking up as parts are more expensive and labour rates and things are going up. But overall, we're really pleased with the loss ratios we're seeing on that portfolio. Just in terms of outlook, I've been the group CEO now for 6 years, and the team of people that we've got in this business running it has never been better. I think the business structure and the strategy has never been better. This business is in very, very good shape, but we still see plenty of opportunity. We thought 10% was a really good aspirational goal, market share in that auto retail division. It's clear we're going to hit that. We need to reset our sights again. But really, there's just so much opportunity still in this used car space. There is a lot of latent demand. 20% of registered cars being 20 years or old means we know there is just a big cohort of cars that need to be replaced over the next sort of 5 or so years. So there's plenty of opportunity for us to keep growing. And a really good, strong, growing auto retail business has this very positive halo effect into finance and insurance. So this whole sort of flywheel of selling cars and it flows into finance and insurance is working, super well. Having said that, what we have seen is real strength in that Turners brand, strength in our systems, our technology, and our people. And we are starting to push ourselves about what else we can do with that brand. And we think there are adjacent opportunities where we can use that strong Turners consumer brand to push into some other adjacent markets. And so we're doing quite a bit of work on that at the moment. And we've never been closer to our 50 goals. So Grant Baker and I, we've always talked about these 50 goals. So the 50 million profit target, which we've been quite open with everyone that was our sort of FY26 goal, FY25, FY26 goal, and being in the NZX 50 club. So we've never been close to that, and that's super good to see. Okay, Doug, back to you for the Q&A.
All right. Thanks, Todd. That was a great presentation. Sounds like things are going really well. I had a few questions around the branch expansion, and that seems to be going very well. And I guess one question was, can you talk about what you think has made the branch in Hamilton so successful? And then secondly, can you go into even smaller regions and have success, and how are you guys going to go about that?
We've been doing this for a while now, Doug, so we're getting the formula well worked. We've learned a few lessons along the way, as you would expect. So it feels like we're getting the approach and things right. We locate and do the developments ourselves, with the help of partners, obviously. And in terms of the market size, Timaru is going to be quite a good test for us. It'll be the smallest sort of regional market that we've been into. We think there's that should be a $500,000 kind of operating profit contribution site. So it's going to be interesting to see how that plays out. But experience today tells us when we move into these new geographies, people know the brand because they've seen it on TV, they've experienced before somewhere else, and they are getting a great customer experience and a great product. And so yeah, that is the reason we get traction very quickly.
Yeah. We do have more questions. There's just that we can send you and we'll get them out to the group. One more that we thought was kind of interesting is, are there any like, I guess, comps or comparable companies that are listed overseas that kind of do what you guys do, or that you see as a model or something you could mimic or get or grow to, or not really?
Yeah.
Is that just kind of?
Yeah, there are a few. So one we do keep quite a close eye on in the US is CarMax. So if people wanting to check that as a business out, it's a very big, large, used vehicle retailer listed in America. Yeah, and there are sort of other examples around the world, but that would probably be the one that's most like us.
Yeah, yeah, interesting. All right, well, Todd, thank you very much. We'll move on to the next, but yeah, thanks for putting all that together and spending some time, and we'll get you more questions and get them out to everyone. But thanks a lot. All right. So now we move on to the next company we have for everyone today, and hopefully Stephen will jump on here in a sec. But the second presenter will be PGG Wrightson, and I'll give them a minute. There he is. Hey, Stephen, how are you?
Hello, Doug. How are you?
Nice. Good, good. So, yeah, we have the CEO of PGG Wrightson, it's Stephen Gerling, and I will turn things over to Stephen now. And same thing, we'll be back in 15 minutes with questions. And everyone, please fire questions away as you have them, and we'll get them in the queue. So, Stephen, over to you.
Thank you. Thank you, Doug. I just want to check that you can see my screen there okay?
Yeah, it looks like we can see two slides. And the one on the right.
That's okay. Yeah, just need to go to full screen mode here.
Okay.
I'm not sure why that's doing that.
Is there a display, change it in your display settings? Is there something in display settings there?
I'm just trying to work that out.
I think it'd be up the top. I can't see, but you're close there. And as it says,
how's that?
Hey, they're perfect. Nice. All good.
Thank you. Sorry, technology. So thank you, everyone, for the time today. As Doug introduced, I'm Stephen Guerin from PGG Wrightson, CEO here, and I've been with the business for 36 years and about 4 and a bit years as the CEO. I'm going to talk to you about PGW. We think of ourselves as being in the food business, and we're a market-leading organisation as far as the food business is concerned. We're spread throughout New Zealand. We have a history that dates back 170 years old. We have 1,800 staff. Every farmer in New Zealand has an account with us. 60,000 account clients. We've stocked up 30-odd thousand products in our range through our store network, although each store doesn't hold that. It depends on the type of customer base we're servicing in a particular area. As an organisation, we're very focused around our technical expertise and innovation. And I've got a few slides to talk about that as far as our business is concerned. Our strategy, we sold our seeds business back in 2019 to DLF, and since that time we've reset the strategy of the business, and there was quite a discussion at that time as to what does a traditional retailing business, rural retailing business look like, and this page here sets out the fundamentals of what our strategy looks like. We're very customer focused. We look to leverage our collective reach across our business. That client that is training lambs from a livestock perspective, we're also providing their grass inputs and feed inputs and nutritional inputs. We're taking that wool through the processing chain. So how do we build on that relationship with that client right across their whole farming inputs? Our differentiated offering, and we'll talk a little bit about that in a couple of slides. Our people are our key. Our customer surveys tell us that the relationships that we hold on farm, and we're dealing with clients, 4th and 5th generational clients as far as the business is concerned, We have people working within our business, which are sons and daughters of clients, grandchildren of clients, such as the heritage of this particular business. Our trade finance solutions, we'll talk a wee bit about that in one of our slides. It's an innovation that we brought into the business. Environment and sustainability is really important, notwithstanding our obligations as an NZX business. That's really important to our clients, and again, I'll talk about that. And we've started to tell our brand story as far as the business is concerned. What does this new organisation look like post the sale of our seeds business? We have a large and wide footprint as far as the organisation is concerned. You can see that represented on this graph. Our business is roughly 50% North Island, 50% in the South Island in terms of revenue earned perspective. And a lot of these locations are multiple locations. Where we have a retail footprint, we have a real estate office or a water site. Our wall stock stores tend to be separate, and as do our sale yards for obvious reasons. We do have one site which shares the sale yard and the retail footprint. That's in our fielding site in the Manawatu. So a really wide footprint. And what the story out of this slide also is that we are part of the fabric of rural New Zealand. That's a key important factor for us. Our sustainability story, there's a lot of information that we've provided in our annual report, which we published 2 weeks ago. That's available on our website. And we are committed to a 30% reduction in our emissions by 2030. And this is really important for us, not only from that regulatory perspective and the legislative perspective, but our clients. We are in the food business. We are providing food into the food chain, and New Zealand is an exporting country of food, and our international clients are in fact driving the demand to have visibility through this information. So notwithstanding the legislative obligations, it's really important in terms of our touch points with our clients. And we're also increasingly seeing this story is really important with our younger people coming into the organisation. What are the values of the organisation that are driving our behaviours, and what are we doing? And I had a really engaging conversation with some of our young members just yesterday, and their ideas around what we should be moving forward with as an organisation. So and it's not just about that legislative obligation. And we support that in terms of our approach, and here's some detail around that. I'm not going to go through this slide in detail, but it does really much fit across the environmental story, our social responsibility stories, and our governance stories. And because we are, as far as a part of that fabric, what we do in a social sense is really important. It's really transparent as far as our community is concerned. The buildings that we operate, the sale yards that we operate, how do they operate? How does anything that we do in those environments impact on the communities if we get something wrong in that space? And the people that are working within those sites is really important. Our technical expertise, I touched on this point, and we've got a picture of Vonnie here, who leads our technical R&D team. And we are looking at new molecules that are 4 to 5 years before commercialisation, such as our relationship with the R&D institutes across the world, be it universities, be it the multinational companies. And we take those products, we're not developing the products ourselves, but we take those products, see how they work in a commercial sense in New Zealand. What is those practices that our farmers need to change in terms of their crop management, or their property management, or their management practices in terms of the way they apply products, etc. And we're working those products through the system and how they stack up against others. And we're one of the few organisations that do that in New Zealand, and we have the largest R&D team in the country operating in this space. I talked again, it's not just limited to that team operates largely in our retail world, but we have genetic specialists operating in the livestock space. And when you're making decisions around buying bulls, etc., they are 10 to 15 year decisions that you're having in terms of the progeny that are going to come through your animals. And you need good insights around that, and we have a team of genetic specialists in there. We have embarked on the world of e-commerce with our clients, and but the e-commerce story for us is a lifestyle story. That's where we've started our focus, but it is becoming more and more a story across our footprint for our what we call our commercial farming enterprises. But the decision around making a decision of which crop you're going to grow, they are made quite in advance of the actual transaction of moving product on the farm. And so we have to have that facility to move the transaction, but the technical advice and decision points are well beyond that. Well before that, I should say. We have an online Ag Online, which is our platform for displaying livestock animals that are available in the marketplace, upcoming sales, etc., and sale yard results. So really transparent and good data for the sector in terms of forward buying decisions. Bidder is a separate brand of our business. It's an online trading platform, real time for animal auctions. It's fully integrated. We live stream our sale yards. We live stream from sales on farm, and that agency is actually opened up to all our competitors. So our competitors are actually using this agency as well. And it's the preeminent online trading platform as far as the livestock business here in New Zealand is concerned. We are a diverse business, and under our retail and water structure that we report in our group results, we have our rural supplies business, our fruit feed supplies business, which is our horticulture business, our water business, and our agri-trade business. And agri-trade is a wholesale distribution business, both through our network and we actually sell out to our competitor networks as well. And we take those brands that aren't represented here in New Zealand from a marketing or distribution perspective, and we third-party manage their distribution here in New Zealand. And it provides us with some opportunities, both from bringing brands to the marketplace, but also margin opportunities. Our agency business is our livestock, wool, and real estate business. I'm going to talk a wee bit more about those in some detail. So our retail business, we term the business retail because it's the blue footprint that you see up and down the country, and people think about them as a shop network. For us, we think about these as a logistical hub. 70% of the decisions that are made in terms of the transactions that we move through that network are in fact made on farm sometime before the product actually may even touch come into our stores and then ultimately move out to our stores. So it's really important in terms of that logistical hub, particularly last mile logistics here in New Zealand. Our rural supplies business, it's between the rural supplies and the fruit feed supplies business. Structurally, they are the same. We have a team in store. We have a team that go out on farm, which we call TFRs. That's built around the technical platform. This network concentrates on our sheep, dairy, and beef clients and our arable clients. And the products you see on there they'll be slightly different to our horticultural background. Our horticultural background is the fruit feed supplies business. It's been a growing part of our business. We've seen land use change, and again, that technical footprint is really important. Our water business is largely a South Island business, but we are selling the big centre pivots with stock water systems that you see here on the Canterbury Plains, and has been providing turnkey solutions. And we're really proud to be partnering with the Valley Technology on that space out of the US. Good quality gear, and again, a long-term investment for our clients. Our agri-trade business, as I said, that's our wholesale distribution business, and I spoke about that previously. Turning to our agency business, our livestock business, one of the more traditional businesses in our network, the movement of animals through the sale yards, and we operate those on a nationwide basis. And increasingly, though, in this space, it's the importance of our supply chain activity and our GO-STOCK story. And this goes to this slide here. So we're operating a product in this business called GO-STOCK. It's a fattening program. So PGW takes ownership of the animals, and you bring them onto your farm. You fatten them up for a period depending on the nature of the species. So cattle are a bit longer than what sheep are, and then we'll take we'll facilitate the transaction all the way through. take a commission on that, providing the finance, get an earn out of that, and then we take the transaction on the way outside, our commission on the way out. Really innovative. It's allowing us to do some work also with supply chain partners such as the meat processors, because we have an end-to-end process and transparency there. But we've talked about, and it's a really innovative business. Our deferrable campaign is where we will finance you a bull, and it is a bit of a seasonal business, but it's a unique and specific business to us. Our wool business, again, a traditional part of our network, and we handle 250,000 bales on an annual basis. We are exporting through our block and bearings business. We export overseas, and we concentrate on that business. We're concentrating on those high value markets, particularly in Europe. Yes, some traders will buy from us into the Chinese market, but they buy through our auction network. But this is about high value marketplaces. We've got some really well regarded brands internationally in this space, so it's a good business for us. Our real estate business, for us, we concentrate on the rural farming market, and the lifestyle market in that space, and in some locations we have a residential marketplace, but it is for in those rural towns where we see farmers coming off selling their properties and moving into a town environment. Quite a small but specific business for us. From an outlook perspective, the macro context when agriculture's had a good couple of years, although at the moment some commodity prices are a bit challenging and we have some climate concerns. But I think it's this slide here that's really important. You look back to 2004, and this is the primary exports, and they have continued to grow year on year. And looking at the data, the food story in New Zealand is actually really good. But depending on whose data you look at, it's between 50 and 57%. The world needs to produce between 50 and 57% more food over the next 25 years. And most of that growth is going to come out of Africa and Asia. And New Zealand is well placed. But it is about the integrity of the food supply chain. And that's why we think we are in the food story. We do a lot in that space as far as our own technical advice, etc. PGW is a really seasonal business. So this graph illustrates that. We are heavily weighted towards the first half of the year, which reflects the farming cycle in terms of our earnings. And we'll talk about that in terms of how the year's tracking with us at the half year, at our shareholder meeting. And on the 25th of October. Sorry, one of my colleagues' phone just gone off. And this is our story around our dividends over the last few years. So we have been a strong growth dividend stock out over the last couple of years. And our share price has slightly ticked up as we've defined our strategy and executed on that strategy. We are a stock that does reflect what's going on in the agricultural sector, although some people think that PGW can be heavily weighted towards dairy. Yes, we are in the dairy business, but I hope I've tried to tell you a story. We are more than a dairy business. We've got a very strong horticultural business. We've got a strong wool business, and we are doing some innovative things as far as the business is concerned. So, Doug, thank you. I think that's my time, and I'm happy to take questions.
Oops. Yeah, thanks, Stephen. That's a great overview. One question well, it's kind of a combination question. Such a diverse business and so many kind of different lines of revenue and things. Are there any in there that particularly are more, I guess, growth focused than others, or more that you expect out of? And then I guess the second part of that was, are there ways that you might leverage technology, kind of similar to what you did with the bidder platform, to help some growth going forward? Are there any, I guess, opportunities to use technology more than you do now, or is it you guys look at?
No, good question, Doug. We would see the growth for the organisation coming out of our retail business and our livestock business. They're probably the two growth ones. The wool story, we are actually really pleased to be in the wool business, but there are some macro challenges that have been there for decades in the wool sector. Yes, merino is a good story, but strong wool is challenging. So, so our concentration and focus is around the retail business. And I'm talking about that new product innovation, the science story, sustainability story, the food growth story, and that world context, which is why we're kind of focused on those two areas. So the second part of the question around technology, yes, the bidder story, but we are introducing technology as far as our crop monitoring services, digitization, automated using drones for spray applications, pest and disease pressure, counting stock out in the field. We've got some work going on in that space, so we're not actually going out in the field and counting animals ourselves. We're partnering with Spark in that space, bring some technology there. So the technology story is really important for us.
Yeah, fascinating. Well, there are a couple more, but we'll get those to you and send them out to everyone. But that's a great presentation, and sounds like things are going well. And I appreciate the time and coming on and sharing the story with us. So thanks a lot, Stephen.
Thank you, Doug.
Okay, so now we're on to our final presenters today, and there they are. They're actually here on site at our office in Auckland, and we've got Radius Care, as I mentioned earlier, and we've got Andrew Peskett, who's the CEO of Radius Care, and Jeremy Edmonds, the CFO. So I'm going to turn it over to you guys and let you get at it, and then be back with questions here shortly. So over to you.
Thanks, Doug, and thank you all for joining us today. This is the second virtual investor event I've done in my 2 years as CEO. It's a pleasure to be here. We want to provide you with a bit of colour on our recent NZX releases and our pending strong results to the NZX for the 6 months to 30 September, before opening the floor to answer some of your questions, which no doubt you'll have, and Jeremy will give an update as well. I'd first of all, again, like to say thank you very much for the opportunity for us to be here and give you a bit of a background to Radius Care. We operate 24 care homes across the country from Northland down to Invercargill and south. We have nearly 2,000 exceptional employees who provide exceptional care to our residents. The jobs they do are absolutely extraordinary, and I regularly visit our care homes through the country and tell our staff that they do absolutely wonderful job for our residents and their families and looking after them on a 24/7 basis. We are a very high acuity business in that we provide full continuum of care to all of our residents, and we are leading the industry in terms of profitability versus our peers, particularly in the listed environment. That's a bit about Radius. Jeremy's here as our CFO, and we'll be presenting, as I said, later quickly on our recent asset sale and bank renegotiations. I'll leave that to him before we open the floor to questions. And firstly, again, I'd like to refer back to our exceptional people. They really are, they turn up day in, day out. Through COVID, they were amazing, and as a result of the work that they do every day, we are able to then talk to our strong results that I'll come to later. We now have a full complement of registered nurse and staff, which is pretty unique to the industry. We've had a full complement for the last 4 or 5 months, and that has enabled us, A, to drive occupancy in our results, and then B, to set up our nursing bureau, rConnect, where we use that as an internal pool throughout the country. If we have nurse shortages in a particular region, Napier, for example, we might relocate them from New Plymouth or wherever our wonderful nurses are prepared to go. And rConnect also is providing nurses to external companies, to other listed operators and big and small operators through the country who do have shortages. So that's a new business and going really well. Pleased to call that out. On our results, we recently announced to the NZX that our results for the 6 months to 30 September will be 40 to 50% up on the prior period. The prior period result was a $7 million underlying pre-IFRS EBITDA, and that will be 40 to 50% more. The prior period actually was a record in itself, so great that we can exceed by up to 50% that result. And just like to give you a little bit of colour around how we've come to those results. Obviously, 30 September has just closed out, so just some colour as to what we've done in that 6-month period to deliver those results. Firstly, I did refer to the full staffing. I think that's absolutely critical that we do have full staffing and can enable not just full occupancy, but good quality occupancy across our portfolio in different care homes, depending on the range and quality of care provided. So, for example, our hospital occupancy, what we call our mix, is a lot higher than it was. It's nearly 80% now, and that helps to drive increased profitability as well. We have, as we mentioned at our full year results, successfully completed a business transformation where we've streamlined operations, we've leaned up the numbers of people in support office, and we're effectively optimising the business through a number of different means. These include an increased granular focus on our accommodation supplement charges. They include diversifying our revenue streams, talking about ArtConnect and others, and a renewed focus on occupancy and mix. We will, as we've said, our results for 30 September will be released to the market, indicating that 40 to 50% uplift, that strong result in late November. We'll let you know that date, likely to be 27 November, let you know in the next few weeks. So please look out for the result and read it in detail. We obviously will disclose full details on the actual numbers and reasons, as I've talked to slightly today, on the 27th of November. Encourage you all to read them. And I'd like to, again, thank you for the opportunity to present today and hand over to Jeremy to talk on asset sales and bank renegotiations, which we've recently released to the NZX. Jeremy.
Great. Thanks, Andrew, and thanks to the NZX for hosting us. This is my first session since I've joined Radius, so it's great to be here. So my job is to give a bit more colour about the balance sheet and, as Andrew said, our asset sale program, our debt reduction program, and how we're tracking with our banking facilities. So first up, we're really pleased with progress on our debt reduction program, and we gave some information about that in our annual report a few months ago. And it's great to see that this progress has been recognised by the ASB, our banking partners, and our bridge facilities of $23 million. They've now been extended to 31st of January 2024. That's quite an important date because that gives a great level of consistency with the asset sales that we've recently announced to the NZX. So on that point, we announced a few weeks ago the sale of Aaron Court, which is a 102-bed facility, one of our 24 facilities, and this one's based in TF2 in Auckland. And we expect to realise $19 million net proceeds from that facility, with settlement in mid-January. Now, all of the proceeds from that will go to repay the vast majority of those bridging facilities. So where we are with that, this sale is conditional on just due diligence and regulatory approval. Neither of those we expect to be barriers. We're in due diligence now, and we should go to unconditional on the 30th of November, and as we said, settlement on the 16th of January. In addition to that, we're still working on some smaller transactions that will repay the remainder of the bridge facilities, and they have similar timelines. So with that, with our significant uplift in trading, Andrew gave you a great deal of colour on the reasons for the positive trading result. That's driving hugely improved EBITDA and good operating cash flow. So with the combination of the asset sales and driving cash from operations, we'll see significantly reduced debt this year. And that's going to leave us well positioned for growth opportunities with a much stronger balance sheet at the end of this year compared to the last financial year. So that's all from me. Thanks for the fantastic opportunity to share some of our story with Radius. And we look forward to any questions from the audience.
Thanks, Jeremy, and back to you, Doug, and look forward to, I think we've probably got 5 minutes for Q&A, so
Yeah.
tell us something, Doug.
Well, thank you, guys. It sounds like an upbeat story. A few questions around just kind of growth strategy. Sounds like you've sold the facility and maybe some smaller ones. What going forward, or what areas do you see the growth coming in? Will you be expanding your footprint in different areas of the country with new homes and care facilities? What's the thoughts there?
Yeah, look, it's a great question. Obviously, this year we are focused on repaying debt to Jeremy's speaking points, and want to execute that by January. Given the metrics that we produce through our industry-leading profitability, and against the backdrop of 1,200 care homes closing in the last year due to reduced profitability, there will be many opportunities for acquisitions into the future once we have right-sized the bank debt, and both from a kind of larger scale M&A and smaller opportunistic acquisitions. Obviously, we'll have to be selective about those and be careful how we structure those deals, but certainly we will look to acquire and further augment our development pipeline that commenced with the completion of the wonderful 24-bed care home at Thornley Park earlier in the year. We will continue then, once again our debt has been right-sized, with implementing a carefully structured development plan as well. So I hope that gives you a bit of colour, Doug.
So this, I guess this year, and Jeremy, you said kind of getting in position, cleaning up the debt to be ready to take advantage of opportunities in the next year or so. And it sounds like it's going well.
It's been a bit of a year of consolidation, but with that much strengthened balance sheet, that really unlocks growth opportunities for us.
Yeah, and are you? It's just my own. As we're talking, when you do expand, there will be acquisitions as opposed to new builds. Do you do facilities from the ground up in any instances?
Look, it'll be a combination, Doug. I think it'll be a capital allocation question.
Yep.
What's the correct allocation of capital, given the opportunity, given the housing market, given debt levels and uplift in value, in enterprise value, and it will depend. We do have a site in Christchurch, 4-hectare site that's wonderfully positioned next to the Countdown and the new school and new infrastructure. Obviously, there's a bit of work to be done to finalise ownership and development pipeline there, but that's a wonderful site. There are other development opportunities, and we just will need to balance the which is best to go first out of that and opportunistic acquisitions.
Nice. Well, guys, that is a great update, and it sounds like things are going well, and you're on your way to accomplishing what you were hoping for so far this year. So thanks for joining us, and we'll have some more questions coming in, but we'll get those to you and then out to the group, and then also all the registered attendees will get the replay link of this webinar. So just want to say thanks, guys, for coming in, and appreciate the time, and and thanks everyone for joining us. So we'll sign off from there, and we'll see everyone on the next one. So long.
Thanks, Doug.
Thank you.
Bye-bye.